Tortoises, there are thousands of investing books out there, and I've read several dozens of them. But there are 5 books I keep coming back to. 5 books that between them build the entire framework both myself and my clients use to determine which companies to buy and which to avoid. Now, I want to be clear, this is not going to be the typical list you see on every channel, and the goal of this video is not to provide you a summary of all of these books. What I'm going to do instead is show you the exact idea each one of them gave me, the specific piece of my process that came from each, so by the end of this video, you will understand not just what to read, but how these 5 fit together into one way of thinking. And as a bonus, I will also show you 4 books that, even though didn't make the core 5, also shaped how I think as an investor. So without further ado, let's jump right into today's video. Okay, guys, so let's talk about every single one of these books and the main ideas that you should gain from them based on my own experience. And for those of you watching this channel for the first time, welcome to the Tortoise world. To give you some background, my name is Eduardo. I'm an investor and investment coach. I've been investing for the last 8 years, following the same principles that I teach here on my channel, and I've been compounding money at about 20% per year without touching my portfolios, basically. And everything that I preach and practice has been built on the lessons that I've learned from reading. And these 5 books are game-changing, as I was saying. So let's talk about the first one, Peter Lynch, One Up on Wall Street. I have that book right here. Let me show you. Already prepared. I have the Spanish version, even though I also read the English version. But Peter Lynch needs no introduction. So this guy has compounded money at 29.9% per year while being a portfolio manager at Magellan Fund. He did it for 15 years, if I'm not mistaken, which is by far the best record certainly among mutual fund managers. I mean, this is staggering. And what did I learn from Mr. Lynch? Invest in companies whose products and services you already use and understand as a customer. One thing that I always, whenever I'm discussing the watch list with a client, the first thing that I always mention is, instead of running like a stock screener or starting like that, why don't you think about companies whose products or services you already buy and are already happy with? So, for example, if you use Amazon, if you use their website, then you may be interested in what the company does in its business model. And you may like the way you may like how the customer service works. You like the way you are treated. You love the quality of the products. You can start from there. It's much easier when you actually start from there, because let's be fair, several of the companies we already know, I mean, they have something. They are all over the place. We know them, and chances are they will be very good businesses. So that is a good ground that's a good point to start with, okay? And you have an edge in the things you already know. So if you are working in the software space, you may be acquainted with several software companies, and you may be taking advantage of the SaaS apocalypse that we are seeing right now. A lot of these companies are they are in the hole right now. I mean, several of them have already recovered, and we have making substantial profits on them. I'm not selling, but that's topic for another video. But the key here is, I worked in the software space because I worked as a QA engineer for 6 years. So I have some experience in that field that people working in the healthcare don't have. And that's completely fine. But the key here is, take advantage of your expertise, of what you already know, and use that to select high quality companies, okay? To use that as a starting point, to start the screening process. And Link's whole point is that ordinary people spot great businesses in daily life before Wall Street does. That's the beginning of a circle of competence. Second, and this is the one that's stuck, over time, a stock price follows the company's earnings. Another thing that I'm always pounding the table on: don't pay attention to the shiny objects or the latest headlines, because what really matters is the business. How is the business performing over time? And do you think the story is sound? Because if it is, chances are it will continue to deliver. And over time, if earnings go up, the stock price will follow. Now, Lynch provides many stock examples throughout the book, and this shows you in a very detailed way. He compares the different stock prices with the earning power of those companies over time, and you can see that while there are discrepancies every now and then, over time they tend to move in tandem, and that makes complete sense, and it's backed by research. Take a look at this image that I have right here: earnings growth versus share price appreciation. This is from so it goes back to the 31st of December 2006, and you can see that even though there are periods of time where price and earnings growth remain somewhat detached, over time they tend to converge, and this is what matters if you are a long-term investor. So I cannot stress how important this is. And he also breaks companies into types, right? So not all companies are the same, and so they should not be treated equally. Of course, duh. So one of the things that I use in my coaching sessions is what you can see right here that I downloaded. You can see in this image, I show people how the business cycle works and how the metric you are using to value a company or to determine its quality should vary according to the business cycle. And so what do I mean by that? If I scroll down right here, then you can see this image, right? So can a startup be valued and analyzed the same way as a company that is in the declining phase? Of course not. They are completely different businesses. Same goes for a company that is in a hyper growth stage and another one that is in capital return stage. You have to be aware of the cycles in order to make sound investment decisions. That said, and if you have been following the channel for a while, then you know this very well, I like to focus on well-established, high-quality companies, and that automatically rules out companies in the startup, the hyper-growth, and self-funding. Self-funding, it depends, but typically yes. So it rules out companies within these three brackets because I like well-established companies, all right? And so, yeah, but you still need to understand this for clarity, and that's why I also teach that. Now, let's talk about more things right here. That habit of categorizing a business before you value, it's something I still do. Okay, so that is Peter Lynch. Now, let's talk about book number 2, Fieldtown. And you can see already here, spoiler alert, that book number 3 is also from Fieldtown. Now, rule number 1, Fieldtown. This is the first book that I actually came across when I was in the process of pivoting from trading to long-term investing, and man, was it awesome. So this is the backbone of my whole process. If out of those 5 there were, if you asked me, if you point a gun to my head, if you could only choose one, what would that be? That would be the book. So this is where the 4 M's came from. So what do I always tell you about? What do I always preach on the channel? The 4 M framework, and that includes meaning, moat, margin of safety, meaning, moat management, and margin of safety. Every single thing that I do whenever I'm analyzing a company needs to go through that 4M process. And again, then the only thing that changes where I built on Fieldtown's framework was inside in each of these 4Ms, I introduced a few things that I learned from other disciplines in other books, like the ones that I'm telling you right here. Okay, but the 4M framework is there. And before rule 1, I had instincts, as you can see. After it, I had a checklist. Does this business have meaning to me? So, for example, one of the things that Fieldtown does not address is if you had to put 50% of your net worth in the business, would you do that? And for me, at least, this changed how I approach investing. Because yes, I can understand how a company makes money, but when you ask me, would you put 50% of your net worth into that business? Even though I may understand the company, my answer may be no. And that has to do with the conviction I have in the business. All right. And because I love to think as a business owner, in the long-term business owner, then that thing right there changes the whole thing for me. Now, does it have a durable moat? Is management trustworthy? Is there a margin of safety in the price? Those are all things you have to take into account. That the book tells you. It also gave me my first proper valuation method, which is the margin of safety approach for fast growing companies. In the book, it's not mentioned that it's for fast growing companies, but I also attended the 3-day virtual workshop that they gave about 6 years ago, and they mentioned that. And think about it this way: the metric that you are using when you are doing the margin of safety calculation is earnings per share. It's like a DCF model. You take the earnings per share, you grow that earnings per share at the projected a projected growth rate over the next 10 years, and then excuse me, you'd multiply that by an assumed PE at that 10-year period. So, for example, if you assume that the growth rate is going to be 15%, the PE could be double that, which is 30, and that will give you the 10-year price per share, which you then need to discount back to the present. So you just divide that by 4, because in 10 years you're going to have 2 doubles, and we always want 15% returns on our money per year. So that's why you divide it by 4, because 10 years, that means 2 doubles. And you get the intrinsic value, which you then divide by 2 to get the margin of safety price. So it has a 50% built in. Now, it sounds a lot like a DCF, right? It's pretty much like it. But the reason you use it for fast growing companies is because you are using earnings per share. And many times, if they are not growing earnings per share at 15% or and beyond, then the margin of safety will give you a very low number, and that makes the whole method unsuitable. And sure enough, you should not use it for companies that are showing sluggish growth, like growing 6 or 7%. You should instead use it for companies that are growing at 15% and beyond. Okay, hope that makes sense. Then we have the payback time, and I love this book. So as I have to mention this, is Philtown is not paying me. I don't have any affiliation, but these 2 books definitely made the whole difference. So rule number 1 gave me the framework. Payback time gave me a second valuation method and a completely different way of seeing a stock. It taught me to value a public company the way an investor values a private business. What do I mean by that? Guys, this book teaches you to value a publicly traded company the way you value a business the way you value a private business. So in private equity, typically the payback time is around 8 years. So when you buy a private business, you are expecting, because liquidity is drier, you expect to recoup your money from earnings in about 8 years. So the reasoning behind this method is, if you can apply that same process to a publicly traded company, boy, would you have a significant margin of safety built in. Because remember, the average payback time for an S&P 500 company is around 16 times. That's the average PE over the last decades. If you can have an average payback time of 8 years, I mean, that means you would be recouping your investment in half that time, which is fantastic, especially if you use free cash flows. And in the book, he does the payback time using earnings per share. However, in the virtual workshop, he used free cash flow per share, and it makes sense because we are already using earnings per share in the margin of safety calculation. So in the payback time method, you use the free cash flow per share. Okay, so that's it. You apply that same 8-year payback time standard to a public company. You end up demanding a huge margin of safety. You are asking a liquid, tradable business to meet the same bar as an illiquid one. If it clears that, you've got an enormous cushion. That reframing, treat the public stock like a private business you are buying whole, is one of the most powerful ideas in my entire process. And you guys know that. Just go back to some of my previous videos. I talk about the payback method at length whenever I'm valuing a business. Okay, now book number 4, the little book that still beats the market, which I have right here. And this is from Joel Greenblatt. This one breaks down 2 numbers and how they work together. This book is so simple to understand and yet so powerful, guys, so powerful. So 2 main things that the book tells you about, and it's all about earnings yield and returns on capital. The earnings yield tells you how cheap the stock is. And so one of the things that Joel Greenblatt wants is you would go for businesses that display high earnings yields, which means you are getting a lot relative to the price you are paying. It can be a sign of cheapness, but it doesn't stop there. He also wants then businesses with returns on capital that are abnormal, high returns on capital. And that tells you how good the business is, because if the business can get more for every dollar it invests, that means it has high quality. Now, when you combine the best of cheapness with the best of quality, boom, that is the core idea behind this business. And it's the core idea behind this magic formula. Okay, so Greenblatt showed that combining the two, buying good businesses at cheap prices ranked by both, has historically beaten the market. It sounds obvious, say it out loud, but he proved it and gave it a simple, disciplined structure. He taught me you don't need complexity to win. You need cheapness and quality together and the discipline to actually stick to it. Why do you think I'm not a core quality investor at heart? So my approach is all about finding, I want the best of quality on the cheap. So I want to invest in high quality companies, not when they are reasonably priced, as a typical quality investor does. I want them with a big margin of safety. And a lot of that idea, high quality on the cheap, came from this book, right? Now, book number 5, Common Stocks and Uncommon Profits by Phil Fisher. Phil Fisher, Warren Buffett says that his entire framework is 80% Ben Graham and 20% Phil Fisher, something like that. And Phil Fisher taught me 3 things that changed how I hold, not just how I buy. First, a generally long-term approach, buying great businesses to own for years, even decades, not to trade. And a good example that he has in the book is Motorola. He started buying Motorola, and he continued to be a shareholder in the company for decades. And he held on through it through market cycles, because he understood the company, he understood management team, as we will discuss about it, as we will discuss as well, and he understood how the company make money, and he understood that the runway for growth was still significant. And it was right. In fact, I think even after passing away, at the time of his death, he was still holding the company. I mean, which is incredible. So buying great companies, hold them for decades. Second, the importance of really understanding the management team. So he's famous for the scuttlebutt method, doing the qualitative homework on the people running the business. That's my management M, and it came from here. So a lot of the things that I've included in the first M meaning came from the method that he discusses in the book. And third, maybe the hardest lesson, not selling a wonderful company simply because it looks expensive. According to what he says, great businesses spend most of their lives looking expensive. So the key here is right, most businesses spend most of their life looking expensive, but every now and then they go through periods of uncertainty that causes the price to crash, and then we tortoises attack, provided the story has not changed. So he taught me that selling a compounder just because of a PE looking high is one of the most expensive mistakes you can make. So notice how these 5 books fit nicely together. The first book by Peter Lynch taught me to invest in what I already understand, companies that I'm familiar with. Then the second book, Rule One by Phil Town, taught me to value a company using the margin of safety method. The third book taught me to value a publicly traded company the way a private equity investor values a private deal. And then we also have Joel Greenblatt, which taught me the importance of combining the best of both worlds, cheapness and quality, so earnings yield and returns on capital. And last but not least, we have Phil Fisher with his book Common Stocks and Uncommon Profits, who taught me who taught me about the importance of understanding a management team and not simply selling a company because it might look expensive. Okay, so these 5 books have been phenomenal. But now, as I promised at the beginning of my video, I want to give you a few perks. So let's give you a few bonuses as well. And the first one that I have right here is more for index investors. I'm not an index investor. However, I also learned from that because not simply because I'm not an index investor, that doesn't mean I'm not reading about different subjects. And so this book right here by what's his name, by John Bogle, who is considered to be who is credited with creating the first index fund, is very good. So it's called The Little Book of Common Sense Investing. You can learn a ton by reading this book as well, even if you are not an index investor. And I'm primarily focusing on stock picking, but this is very good. The second book that I also have right here is primarily for those who are just getting started and may find all of this a little overwhelming. And this is very, very good. I read this book not that long ago. It's called The World's Simplest Guide to Stock Market by Edward Ryan. It's an introduction to company stocks and making money from investing. It tells you everything. It teaches you everything as if you were completely unaware of everything that we are discussing right now. So it really breaks down investing in simple terms. What is an index fund? What is a stock? What are shares? So this is a very good starting point for those of you who are beginners. And then I also read this book by Sven Carlin, and many of you who are following this channel are already aware of this YouTuber, and rightly so, because his content is phenomenal. So I read this book a few years ago and I strongly recommend it. I don't have any affiliation, again, no partnerships, but I found the book very telling. It's called Modern Value Investing, and the goal of the book is to build on the first book that was put out by, what was his name, by Seth Klarman, one of the best investors of all time, called Margin of Safety. This book is basically an extension to that book. Okay, so it's very good. It's the margin of safety in modern days. And so I definitely recommend you reading, not least because he mentions and breaks down several of the techniques that he uses to select companies. Okay, these 5 books gave me the raw material, the ideas one at a time, over years of reading and trial and error, and I don't shy away from all the mistakes that I made over time because they only made me a better investor. And so, guys, if you would like to get your hands on that 4M framework that I discussed at length on my channel, I will leave a link in the description below. You can download it. It's absolutely free, and it comes with several of the metrics that I like to look at whenever I'm running through the 4M screener in hopes of determining which companies I want to invest in and in which ones I want to rule out. And in addition, if you want to speed up the learning curve and build your own version of this directly with me, I will also leave a link in the description to join a free advisory call directly with me so we can map out a game plan that you can start implementing right away. I'll see you on the other side, Tortoise.